The Commodity Channel Index calculation requires four essential components that work together to measure price momentum. The first component is the typical price, which is the average of the high, low, and close prices for each period. This gives us a balanced representation of the price action within that time frame. For example, if a security has a high of 105, a low of 95, and closes at 102, the typical price would be calculated as 100.67. The second component is the simple moving average of the typical price over a specified number of periods, commonly 20 periods. This smooths out price fluctuations to identify the underlying trend. For example, a 5-period SMA calculates the average of the last 5 typical prices. If those prices were 99, 102, 100, 101, and 103, the SMA would be 101. The third component is the mean deviation, which measures how much the typical price varies from its simple moving average. It's calculated by averaging the absolute differences between each typical price and the SMA. For our example, we find the absolute difference between each typical price and our SMA of 101, then average these differences. This gives us a mean deviation of 1.2. The fourth component is the scaling factor of 0.015. This constant value was selected by the indicator's creator to ensure that the majority of CCI values fall within a range of plus or minus 100. When we put all these components together, we get the complete CCI calculation. Using our example values, a typical price of 100.67, an SMA of 101, and a mean deviation of 1.2, our final CCI value would be minus 18.33. To summarize, the CCI calculation requires 4 key components: the typical price, which provides a balanced view of price action, the simple moving average, which identifies the trend, the mean deviation, which measures volatility, and the scaling factor, which standardizes the output range. One of the primary uses of the Commodity Channel Index is identifying overbought and oversold conditions in the market. Let's look at how CCI can help traders identify potential price reversals. The CCI oscillates around 0, but has 2 important threshold levels at positive 100 and negative 100. When CCI exceeds positive 100, the market is considered overbought, suggesting prices may be unsustainably high. Conversely, when CCI falls below negative 100, the market is considered oversold, suggesting prices may be unsustainably low. These extreme readings in the CCI often precede price reversals, as the market corrects these imbalances. When using CCI as an overbought-oversold indicator, traders should look for these extreme values as potential signals for entering or exiting positions. Remember that while these signals can be powerful, they should be confirmed with other technical analysis tools for the most reliable trading decisions. The Commodity Channel Index, or CCI, can be adjusted to match different trading styles by changing its time period setting. Looking at the same price action, we can apply CCI with different period settings to see how sensitivity changes. The default setting for CCI is 20 periods. This provides a good balance between generating timely signals and avoiding excessive noise. When we reduce the period to 10, the CCI becomes much more sensitive. It generates more trading signals, but also more false positives. Short-term traders often prefer this setting for catching quick moves. Increasing the period to 40 creates a much smoother CCI line. It generates fewer signals, but they tend to be more reliable. Long-term traders and investors typically prefer this setting. Let's highlight the trading signals generated by both settings. Notice how the 10-period CCI produces more signals, while the 40-period generates fewer but potentially more reliable ones. When selecting your CCI period setting, consider your trading time frame. Short-term traders often use 10 to 14 periods for more signals. Medium-term traders typically stick with the default 20 periods. Long-term traders and investors prefer 30 to 50 periods for more reliability. The Commodity Channel Index helps traders identify trend strength and direction. During strong uptrends, CCI tends to remain above the 0 line, frequently reaching overbought levels above plus 100. Conversely, during strong downtrends, CCI typically remains below the zero line and frequently reaches oversold territory below minus 100. The persistence of CCI readings in positive or negative territory provides confirmation of the trend's strength. The longer CCI remains above or below zero, the stronger the prevailing trend. To summarize, CCI provides valuable insights for trend identification. When CCI remains above zero, it indicates an uptrend, while readings below zero suggest a downtrend. CCI reaching overbought or oversold levels confirms the strength of these trends. Remember that persistent CCI readings in either territory provide strong validation of the prevailing trend direction. Combining the commodity channel index with moving averages creates a powerful approach for timing entries and exits within established trends. Let's examine a price chart with a 200-day moving average, which helps identify the overall trend direction. Below the price chart, we'll add the CCI indicator, which oscillates above and below the zero line. When price is below the moving average and CCI crosses below zero, we have a reinforced bearish signal. Conversely, when price is above the moving average and CCI crosses above zero, we have a reinforced bullish signal. This combined approach offers several key advantages for traders. By using the moving average to confirm the overall trend and CCI for timing, traders can reduce false signals and improve their trading decisions. The commodity channel index can be particularly useful when analyzing support and resistance levels. Support and resistance levels are key price areas where the market has historically reversed. When price breaks through these levels, CCI can help confirm the strength of the breakout. The CCI oscillator typically ranges between plus and minus 100, with readings outside this range indicating extreme conditions. Let's look at a bullish scenario. When price breaks above resistance and the CCI indicator is positive and rising, it suggests strong momentum behind the breakout. Conversely, in a bearish scenario, when price breaks below support and the CCI is negative and falling, it confirms strong downward momentum. This relationship between price action and CCI momentum significantly increases the reliability of breakout trading strategies. False breakouts often lack momentum confirmation from indicators like CCI. By waiting for CCI confirmation when trading breakouts and breakdowns, traders can filter out many false signals and focus on higher probability trades with stronger directional momentum. In range-bound markets, the commodity channel index behaves differently than in trending markets. A range-bound market is characterized by prices moving sideways between established support and resistance levels. When markets are range-bound, the CCI oscillator tends to fluctuate more frequently between overbought and oversold levels. This creates an opportunity for traders to implement a mean reversion strategy, buying when the market is oversold and selling when it's overbought. The mean reversion strategy for CCI in range-bound markets consists of four key components. First, identify a range-bound market where price is moving sideways between clear support and resistance levels. Second, look for buy signals when the CCI drops below negative 100 and then crosses back above this threshold. Third, watch for sell signals when the CCI rises above positive 100 and then crosses back below this level. Finally, remember that this strategy works best when there's no clear trend in the market. Let's look at a practical example of how this strategy works in a range-bound market. Here we can see a buy signal when the CCI crosses back above negative 100 after falling below this threshold. Later, we see a sell signal when the CCI crosses back below positive 100 after rising above this level. The CCI indicator in range-bound markets offers traders clear mean reversion signals, taking advantage of the regular oscillation between overbought and oversold conditions. Analyzing the commodity channel index across multiple timeframes provides traders with a more comprehensive understanding of market conditions. Let's examine how CCI appears across three common timeframes: monthly, weekly, and daily charts. When CCI shows bullish signals across multiple timeframes, it indicates a strong uptrend with alignment across different time periods. Notice how all three timeframes show CCI readings above the plus 100 level. This alignment strengthens the bullish signal and suggests a robust uptrend. Conflicting CCI signals across timeframes might indicate uncertainty or an impending change in trend direction. In this example, the monthly timeframe has just turned bearish. The weekly timeframe shows a strong bearish trend, while the daily timeframe is showing a fresh bullish signal. This conflict suggests a potential trend reversal or range-bound market. A practical framework for multiple timeframe CCI analysis starts with using the higher timeframe to establish the overall trend direction. Then use the middle timeframe to confirm trend strength and momentum. Finally, use the lower timeframe to time your entries and exits with better precision. Let's look at a practical example of this framework in action. To summarize, when analyzing CCI across multiple timeframes, remember, alignment across timeframes confirms trend strength. Conflicting signals warn of potential trend changes. Higher timeframes show the bigger picture, and lower timeframes improve timing precision. Combining CCI with volume analysis significantly enhances signal reliability. When analyzing price action using the commodity channel index, adding volume data provides confirmation of the strength behind market moves. The CCI indicator helps identify overbought and oversold conditions with the plus 100 and minus 100 thresholds. Volume acts as a confirmation tool. When CCI signals align with above-average volume, it indicates stronger market conviction. Let's review the key benefits of combining CCI with volume analysis. By adding volume analysis to your CCI trading strategy, you can filter out false signals and focus on high-conviction trade opportunities with greater potential for success. The commodity channel index differs from other momentum oscillators in several key ways. Let's compare CCI with two popular oscillators, Relative Strength Index, or RSI, and the stochastic oscillator. One major difference is that CCI has no upper or lower bounds, while RSI and stochastic are bounded from 0 to 100. CCI is also more sensitive to price changes due to its mathematical formula, which uses mean deviation. For overbought conditions, CCI typically uses plus 100 as a threshold, while RSI uses 70 and stochastic uses 80. Similarly, for oversold conditions, CCI uses minus 100, RSI uses 30, and stochastic uses 20. A significant advantage of CCI is that it rarely gets stuck in overbought or oversold territories during strong trends, unlike RSI, which often does. Visually, we can see how CCI's unbounded nature allows it to show extreme readings during strong trends. RSI, unlike CCI, is bounded between 0 and 100. Notice how it tends to get stuck at its 70 and 30 thresholds during strong moves. The stochastic oscillator, also bounded from 0 to 100, is more responsive than RSI, but still has defined thresholds at 80 and 20. To summarize the advantages of CCI compared to other momentum oscillators, CCI has no upper or lower bounds, allowing it to show extreme readings during strong trends. It offers higher sensitivity to price changes due to its formula that incorporates mean deviation. CCI is less likely to get stuck at extreme levels during prolonged trends. This allows CCI to show stronger and clearer divergence signals. And finally, CCI tends to signal changes in trend direction earlier than bounded oscillators like RSI or stochastic. Optimizing CCI parameters is essential for improving performance with specific assets. The standard CCI uses a 20-period setting, but optimizing this parameter for specific assets can significantly improve performance. Here we can see how different period settings affect the CCI indicator. Shorter periods like 14 create a more responsive but potentially noisy indicator. The standard 20-period setting offers a balance of responsiveness and signal quality. Longer periods like 50 smooth out the indicator, reducing false signals but potentially delaying entries and exits. The standard CCI formula uses a constant factor of 0.015 in the denominator. Some traders adjust this value to create custom sensitivity levels. A smaller constant like 0.010 creates a more sensitive indicator that reacts more strongly to price changes. The standard 0.015 constant provides a balanced sensitivity that works well in most markets. A larger constant like 0.020 reduces sensitivity, creating a smoother indicator that may help filter out market noise. Backtesting is crucial when optimizing CCI parameters. Different markets and assets respond better to specific settings. As we can see in this performance comparison, stock markets tend to perform better with medium-length CCI periods around 20, while Forex markets often show better results with shorter periods, like 10 or 14, which capture the faster price movements typical in currency trading. When optimizing CCI parameters, keep these key considerations in mind to achieve the best results. Match your CCI period to your trading time frame. Shorter timeframes generally work better with shorter CCI periods. Test your parameters across different. Consider adjusting the constant factor based on the asset's volatility characteristics. Be careful to avoid over-optimization. Parameters that fit historical data perfectly may perform poorly in real trading. For advanced strategies, consider combining multiple CCI settings to confirm signals and filter out noise.